Let's talk a little bit about cost classification. And we have variable, we have fixed, and now we have mixed, which is a portion of it variable and a portion of it fixed. And so when we're working in managerial accounting, we have two types of income statements. We have the traditional income statement, which is your revenue minus your cost of goods sold, which gives you gross margin, minus your operating expenses, which gives you your operating income. And that's a very, very small skeleton of a traditional income statement. And then we have the contribution margin income statement. And this is something we use internally to help understand, and I'm going to go ahead and put this one as our external. This is governed by GAAP. And as I said, generally accepted accounting principles. There's a lot more to it than that, but just kind of just getting a general idea, that's what it looks like. So on a contribution margin, we would have our revenues minus our variable cost, which gives us our contribution margin, minus our fixed cost, which gives us our operating income. And we'll talk more later on about how those can be different, but for now, just kind of keep in mind that your operating income is the same. So what we see right here in a traditional, our cost of goods sold reflect our product cost, which is our direct materials, our direct labor, and our manufacturing overhead. These can be variable and fixed or fixed. Our operating expenses, these are our period expenses. So these product costs are expensed when the goods are sold. So the cost of the goods sold. So until they're sold, these costs are sitting in inventory. Operating expenses are expensed when incurred. So if we're looking at a traditional, we can't really see the impact of fixed and variable cost on our cost volume profit, which is something we analyze. And so we come down here and we separate them into variable and fixed. So our variable can have some product and period, and our fixed can have some product and period. But at least this way we can kind of see as sales go up, our contribution margin goes up, our fixed costs stay the same, and we have a better tool to analyze from an accounting perspective, from a management perspective. So the mixed cost is where we get into a little like, okay, if we have a cost and it's part fixed, part variable, how do we determine how much is fixed and how much is variable? And so there's a method we use called the high-low method. And the high-low method will help you separate those mixed costs. But for now, we're just looking at cost classification and how we use those in managerial accounting. So if you have some data or some financial data and you're trying to put that together in a managerial accounting format, then you're probably going to want to do a contribution margin income statement. And so, for example, if you have cost of goods sold, let's go over here. You have cost of goods sold and it's $40 per unit. And you have advertising expenses. Let's say those are $200,000 a month. And you have sales commissions that are 10% of sales. And you should be looking at these now and going, okay, that's variable, that's fixed. You have shipping expense, for example, that might be say it is $2 per unit plus an additional $20,000 per month. That's a mixed cost. It's already been separated for you. And then you have administrative salaries of usually that's going to be a fixed cost. So we'll say $400,000 a month. And then we have insurance expense. We'll say that is $3,000 a month. And then we'll throw depreciation in there. We don't want to ever forget about depreciation. And let's say depreciation is $7,000 a month. Okay, so these are just some variable and fixed expenses. I'm going to go ahead and move this one over so it's in line with the others. So cost of goods sold, direct material, direct labor, manufacturing overhead. And they're telling us, and I'm telling you, this is $40 per unit sold. We're going to call it sold, not manufactured. And if we wanted to look at a problem like this, and let's say we have 24,000 units that we sell, and let's say that our sales price per unit is, we'll say $120 sales price per unit. So if I wanted to set this up in a traditional income statement, I would have my cost of goods sold and my advertising, my sales, my shipping, administrative, insurance, depreciation would be part of my operating expenses. But let's say instead I wanted to do a contribution margin income statement. So I would start with my revenues, and my revenues are $120 per unit, and I'm going to sell 24,000 units. And then I would have my variable cost. And since I have more than one, I'll separate those out. So I've got my cost of goods sold, and then I would have my shipping, and then I would have my sales, because those are variable. They vary based on sales. And my cost of goods sold is $40 per unit sold, and my shipping is $2 per unit sold, and my sales is 10%. My sales commission is 10% of my sales. So then I would have my total variable cost. And you can type a formula in here, or however you choose to use Excel. And then I would have my fixed cost. And I would show my advertising, my shipping, the part that's fixed, my administrative salaries, my insurance, and my depreciation. So I would show each of those as my fixed expenses. Shipping was $20,000 a month, administrative $400,000 a month, insurance $3,000, and depreciation $7,000. Then I would have my total fixed cost. And then I would have my operating income, which is my contribution margin, which I did not calculate yet. So let's go back and do that. Right here, I would want to insert a line and have my contribution margin, most important thing, and I forgot it, which is my sales, my revenues, minus my total variable cost. And then I would have, oh, you know what? This is all off because I've moved that down. So fix that. Okay, then I've got my fixed cost, my total fixed cost. And so I've got contribution margin minus fixed cost is my operating income. So that's a contribution margin. Now, just to compare, if you had a traditional, and I would have my cost of goods sold and my gross margin, then I would have my operating expenses. And I would have each one of those listed out. I've got my shipping, my sales, commissions. I've got my advertising. I've got my administrative salaries. I've got my insurance and my depreciation. And so I think I got everything. Shipping, sales, commissions, advertising, administrative salaries, insurance. And that would give me my total operating expenses, and then I would have my operating income. Now in this example, they're going to be the same. My revenues are still 120,000 times the number of units I sold. My cost of goods sold is $40 per unit times the number of units I sold. And my gross margin then is my revenues minus my cost of goods sold. And then I would have all of my shipping. Now this one's going to be a little bit different. For shipping, you're going to have the variable and the fixed. So you're going to have the $2 per unit, or 48,000. Plus the fixed part. And then my sales commissions are still going to be 10% And what I want you to see though, that these are down low now. They're not up high where we're seeing them as a contribution margin component. Our advertising is 200,000. Our administrative is 400,000. Our insurance is 3, and our depreciation is 7, which gives me a total operating expenses. And then I have my operating income, which is my gross margin minus my total operating. And if I did this right, these will match, and they do. Okay, but what this one does is it enables me to calculate my contribution margin. And so my contribution margin divided by my sales tells me that's 55%. So for every dollar of sales I have, 55% of that is going to contribute toward covering fixed cost and operating income. And so this is really why we classify cost in managerial accounting, so we can go back and do this contribution margin income statement. And later on, we'll talk more about how sometimes these can be different depending on the type of costing method we're using back up here in our product cost. But we'll get into more of that later. For now, I just want you to be comfortable with the variable and fixed cost, and I want you to be comfortable with the different types of income statements that we use, the traditional and the contribution margin.